Crypto winter is here, and it's the coldest we have seen in history.
Overall, the crypto market has lost nearly $2 trillion in market value since last November.
It's just the beginning of crypto winter, to be very honest.
The contagion we are seeing spreading across.
How much lower is Bitcoin going to go?
Bitcoin is down 62% from its peak in November 2021 to its current price. Trillions in value have been erased and billions frozen on crypto exchanges.
Now, as worrying as this sounds, we've seen cycles like this before, and it's actually pretty common.
Today we're going to have a look at crypto winter, what it is, what does it mean for companies in the crypto ecosystem, and perhaps most importantly, will spring come again? Crypto winter is an expression used in the industry to refer to an extended downturn in the price of cryptocurrency.
Analysts and cryptocurrency companies predict that this winter is going to last for a while. The sell-off in Bitcoin and Ethereum year to date has exposed some glaring weaknesses in the digital asset economy.
First, we had the third largest stablecoin Terra collapse in May of 2022. Like the name suggests, stablecoins are meant to have a fixed peg to another currency, like the US dollar, that remains constant. But the pressure on cryptocurrency caused the currency to unpeg, failing to meet its goal of matching the US dollar. $60 billion effectively disappeared as the stablecoin collapsed. Second, a number of crypto companies are being exposed for their unprofitability. In June, a string of corporates laid off thousands of staff in an attempt to get leaner for winter. The largest corporate crypto exchange, Coinbase, laid off around 18% of their total staff. Many of these companies derive revenue from the volume of crypto trades, and expectations of subdued trading means subdued revenues.
Finally, and perhaps the most concerning, some crypto exchanges have started to halt withdrawals.
Vold, Babel Finance, and Coinflex all stopped depositors pulling out their money due to extreme market conditions, and the worst hit players in the market have collapsed completely. On June 29, crypto hedge fund 3 Arrows Capital went bankrupt after defaulting on a loan from cryptocurrency lender Voyager Digital. A week later, Voyager Digital also collapsed. In July, another popular cryptocurrency lender, Celsius, also filed for bankruptcy, citing a $1.2 billion hole in their balance sheet from bad debts.
All of this sounds a bit like a death knell for cryptocurrency companies, and it's certainly a meltdown, but it's not necessarily all bad news. Here's why. Because markets are doing exactly what we expect them to do, penalizing organizations and instruments that are fundamentally flawed or poorly run.
Let's talk a bit about industry cycles and shakeouts. Have a look at this chart. This is a life cycle for a new industry. When a new technology is developed and companies start to sell or derive revenue from that new product, they tend to follow a life cycle.
This cycle can be modeled across multiple industries over the last century. Automobiles, digital cameras, TVs. Let's have a look at internet companies.
Initially, the internet was used primarily for email and niche interest groups. Few people really understood the technology, and actual distribution channels for monetization were limited. The industry moved to a growth phase when Amazon launched in 1994, followed by eBay in 1995. Here, revenue began to rise and companies began to provide value to customers. Huge adoption of personal computers and the World Wide Web drew capital from venture capital firms, institutions, and retail investors. The seemingly endless stream of IPOs from 1998 were cheered on by markets involved in one of the longest running bull markets in history. The result was a cast of dot-com companies such as Pets.com, an e-commerce company that sold pet supplies to retail investors.
Most of these companies operated at a loss, selling product at a loss in order to gain market share and spending heavily on advertising to raise awareness. Pets.com spent around $20 million on a marketing campaign to create this mascot. That's 24% of their $82.5 million IPO capital raising. $20 million on a sock puppet.
How could they do this to socks? Oh no.
After the US Federal Reserve began a rate hiking cycle in 1999, dot-com company share prices started to waver and the industry entered a shakeout stage. Fears of a bubble began to spread and eventually everything began to tumble. The dot-com bubble had completely deflated by October 2002 and the Nasdaq had dropped by 77% from its peak.
Rising interest rates, growing popularity amongst retail investors, trillions of dollars lost. Does that sound familiar?
Imagine if we replace .com companies with cryptocurrency innovators. Many experts think we're here, in the shakeout phase. Companies are going through growing pains that come with any new technology.
Now, back to the dot-com bubble.
In a 2015 book, venture capitalist Fred Wilson, who lost 90% of his net worth when the bubble burst, said about the dot-com bubble, "Nothing important has ever been built without irrational exuberance," meaning that you need some of this mania to cause investors to open up their pocketbooks and finance the building of the railroads, or the automobile, or the aerospace industry, or whatever. What came out on the other side of the dot-com crash were survivors like Amazon, eBay, Adobe, and a framework for new internet companies to be launched.
And despite detractors of internet companies at the time, here you are watching this video on Google's YouTube after Benny edited it in Adobe's Premiere Pro. Internet companies are alive and well.
Is it so unbelievable to suggest that crypto companies are comparable to internet companies in the late 90s and early 2000s?
And there are telltale signs that cryptocurrency companies are still alive. For example, profitable companies with strong cash flows are acquiring other distressed crypto companies.
Crypto exchange FTX purchased BlockFi last month. Goldman Sachs is also reportedly looking to raise $2 billion to buy up distressed assets from Celsius. Big financial institutions are indicating that they believe the crypto industry is going to come back, despite the rapid fall in the value of cryptocurrencies.
We'd argue that what we're seeing here is a process of refinement as the crypto industry develops and matures from its infancy.
Investors who are seeking to gain exposure to companies in the crypto space rather than cryptocurrency itself, but who might be worried about picking individual cryptocurrency stocks that won't make it through crypto winter, can also consider an investment vehicle. One example is the Betashares Crypto Innovators ETF. This fund provides exposure to the largest companies in the cryptocurrency economy without having to try and pick which individual companies like Coinbase or Silvergate Capital to invest in.
Thanks for watching this video. If you enjoyed it or learnt something, please subscribe to our channel for more educational content or check out our website at betashares.com.au. Bye for now.